In today's video, I want to take you back to the single worst day in the history of the American stock market, October 19th, 1987, Black Monday. Because right now, with the weakening labor market, oil prices above $90 a barrel, rising inflation, and a Federal Reserve that does not know which way to turn, I think the lessons from that day are more relevant than they have been in decades. And I want to show you exactly which investments survived the carnage, which ones came out on top, and which ones turned completely to dust. Because the pattern of what happened then is playing out again right now, and most people are not paying attention. So let me give you the thesis up front, and I want you to really hear this. On October 19th, 1987, the Dow Jones Industrial Average lost 508 points in a single trading session. That was a drop of 22.6% in one day. To put that in modern terms, that would be the equivalent of the Dow losing roughly 10,000 points by the time the closing bell rings today. $500 billion in market capitalization vanished by 4 o'clock in the afternoon, and worldwide losses across global markets totaled $1.71 trillion. Now, I want you to understand something. Prior to that day, the market had been on an absolute tear. By late August of 1987, the Dow had already gained 44% in just 7 months. People were euphoric. They were living in ignorance, living in bliss. And that is exactly what made the fall so devastating. Now, here is what the mainstream story always tells you. The mainstream story about Black Monday is that it was a one-off event, a freak accident caused by computerized trading programs, a technical glitch, something that could not have been predicted and that the smart money had no warning about. That is the propaganda that has been repeated for nearly 40 years. But you might say, Brian, if it was so predictable, why did almost everyone lose money? Let me show you why that narrative falls apart. Take a look at what was happening in the months leading up to October 19th. The U.S. trade deficit was expanding rapidly. In September of 1987, the trade deficit stood at $15.7 billion, well above market expectations. The dollar had depreciated by approximately 18% against the German mark and the Japanese yen from the start of the year to October. The Federal Reserve was raising interest rates. The Fed funds rate was sitting at 8.25 to 8.50%. And Treasury Secretary James Baker, just 2 days before the crash, publicly threatened to devalue the US dollar to deal with the trade imbalance. The warning signs were right there on the wall. The writing was on the wall, every single one of them. But people were greedy and they did not want to get out of the market. One trader who was alive at the time said, and I am quoting the sentiment here, everybody knew the market was overpriced, but everybody was greedy and didn't want to miss out on the continuation of the run. Sounds familiar, does it not? Now I want to walk you through the 3 investments that not only survived Black Monday, but in some cases absolutely thrived. And then I am going to show you what turned to dust. Because understanding both sides of this is the whole point. Investment number 1, U.S. Treasury bonds. I want to show you this. When the stock market fell off a cliff on October 19th, investors did something completely predictable. They ran straight into U.S. government bonds. It is the oldest flight to safety trade in the playbook. When fear takes over the market, when panic spreads from Hong Kong to Tokyo to London, and finally hits New York, institutional money does not sit in cash. It moves into treasuries. And on Black Monday and the days that followed, that trade was absolutely explosive. The 2-year treasury yield collapsed by 117 basis points in just 3 trading sessions after Black Monday. Now let me explain what that means in plain English. When bond yields fall that sharply, that fast, it means the price of those bonds went up dramatically. People were bidding up treasury bonds at a historic pace. In fact, that 3-day move in the 2-year treasury yield remains one of the biggest 3-day yield collapses in modern financial history, bigger than what happened after the September 11th attacks. Think about that. So if you were sitting in U.S. Treasury bonds on October 19th, 1987, you did not just survive. You made money while everyone else was watching their portfolios disintegrate. And this brings me to a point that I make constantly on this channel. When the economy starts to crack, when the data starts deteriorating, having a portion of your wealth in high-quality bonds is not just a defensive move. It is a potentially profitable one. It is a no-brainer. And right now, by the way, we have a Federal Reserve sitting on rates well above neutral with a labor market that lost 92,000 jobs in February and an unemployment rate that has been quietly ticking higher. The setup for treasuries today rhymes very closely with 1987. I am just saying. Investment number 2, gold. Now this one is more nuanced, and I want to be honest with you about the intraday picture because I am not here to tell you a clean story. I am here to tell you the true story. On the actual day of Black Monday itself, gold initially surged by nearly $20, hitting $491.50, and then it reversed. It actually fell back as investors who were getting margin calls sold whatever they could, including gold, just to raise cash. That is what happens in a liquidity panic. People sell their good assets to cover their bad ones. However, here's what is important. Here is the real story. If you look at the full year of 1987, gold went from $400 an ounce at the start of the year to $499 an ounce by December. That is nearly a 25% increase in demand in the aftermath of the crash. The people who held gold throughout 1987, who did not panic and sell it on October 19th to cover margin calls, ended the year with a meaningful gain. And that is the lesson. Gold is not a trade. It is insurance. It is the asset you hold precisely for the moments when the financial system is under the most stress. And listen, when you compare the environment of 1987 to what we are living through today, I want you to take a look at this. Rising inflation, check. Rising oil prices, check. A weakening dollar, check. A Federal Reserve that is behind the curve, check. Geopolitical tensions causing supply chain disruptions, check. If you were looking for a parallel to 1987, you do not have to look very hard. Investment number 3, quality businesses held with conviction. Now, this is the one that nobody wants to hear because it requires patience and discipline. And those are not qualities that are in great supply when the market is falling 22% in a day. But here's the data. Despite the ravages of Black Monday, the US market recouped nearly 60% of its losses in just 2 trading sessions. And less than 2 years later, US stock markets had surpassed their pre-crash highs. The Dow Jones actually ended the calendar year of 1987 with a small positive gain for the full year. Read that again. The single worst one-day percentage crash in stock market history happened in 1987, and the market still finished the year positive. Now, who is best positioned for this? The patient capital. The investors in quality companies with real cash flows, real earnings, real products people needed, regardless of what was happening on Wall Street. These companies got dragged down with everything else on that day, but they snapped back first and hardest. And one man who understood this better than almost anyone else was Warren Buffett. He did not liquidate in a panic. He held his positions in quality businesses through the chaos, and he came out the other side in a far stronger position. But you might say, Brian, what are you talking about? If quality stocks also fell on Black Monday, how does that count as surviving? And that is a fair point. So let me be specific. Surviving a crash does not mean your portfolio does not drop on the worst single day in market history. What it means is that your investment retains its fundamental value, recovers, and ultimately goes higher. The businesses that survived Black Monday were not the ones chasing momentum or leverage to the eyeballs. They were the boring, unglamorous, essential businesses, consumer staples, healthcare, utilities, the kinds of companies that sell things people need, whether the stock market is up or down. That is the real story that the mainstream financial media buries under all their excitement about the latest AI darling or the hottest new IPO. And I find that deeply, deeply unsettling. Now, let me show you the other side of this, because this is just as important. Let me show you what turned to dust. The first thing that turned to dust was the junk bond market. And I want to be precise about what I mean here. In the years leading up to Black Monday, the American financial system had become absolutely addicted to junk bonds, which are high-yield bonds that pay big interest rates precisely because the companies issuing them are high-risk borrowers. These bonds were the fuel for the leveraged buyout craze of the 1980s. Companies were borrowing massive amounts of money at high rates to buy out other companies. What this means in plain English is that they were spending more than they had coming in and betting on borrowed time. When the crash hit, this entire ecosystem froze. Junk bond issuance collapsed almost overnight. The only major deal that got done in the week of Black Monday required an interest rate of 17.5%, 8.5 points above the prime rate. And even then, the underwriter, Drexel Burnham, could not sell the whole deal and had to hold some of it themselves. The junk bond market, which had looked like a permanent machine for generating wealth in the mid-1980s, was exposed for exactly what it was: an unsustainable house of cards. And Michael Milken, the king of junk bonds at Drexel Burnham Lambert, would be indicted just 2 years later. That entire world turned to dust. The second thing that turned to dust was the IPO market. On the very day of Black Monday, 229 businesses had filed paperwork with the SEC declaring their intention to go public. They were ready to sell shares to the public and raise billions. And within 9 months of the crash, approximately 45% of those companies abandoned their IPO plans entirely. Nearly half of all planned public offerings just evaporated. The enthusiasm, the momentum, the irrational exuberance that had driven companies to go public at any valuation just disappeared. The companies that had been valued on hope and hype and the continuation of the bull market found out very quickly that when the music stops, the game is over. The third thing that turned to dust was portfolio insurance. Now, this is important because I want to talk about the role that technology played in accelerating the disaster. In the years before Black Monday, institutional investors had adopted a computerized hedging strategy called portfolio insurance. The idea was brilliant on paper. You use futures contracts to automatically sell stocks as the market falls, which protects you from losing money on the downside. What this means is a computer program was set up to automatically sell the market if prices started dropping. What could go wrong? Everything. What nobody modeled correctly was what happens when every major institutional investor is running the same computer program at the same time. As prices started falling on October 19th, all of these programs triggered simultaneously. They started selling, which caused prices to fall further, which triggered more selling, which caused more price declines. According to a report from the Securities and Exchange Commission, program trades made up nearly 60% of total trading volume on the New York Stock Exchange on Black Monday. The very tool that was supposed to protect investors turned into a self-reinforcing catastrophe. It accelerated the crash to a degree that no human being would have allowed. And this is not just a historical footnote. Today we have algorithmic trading that makes 1987-era portfolio insurance look like a pocket calculator. The feedback loops in today's market are orders of magnitude more powerful. This should concern every serious investor. Now, but you may say, why is this relevant to me today? Brian, 1987 was almost 40 years ago. Let me show you why this matters right now. Take a look at the conditions that created Black Monday. An overextended stock market, up 44% in 7 months before the crash. Trade tensions with major economic partners. A Federal Reserve dealing with rising inflation. Geopolitical conflict driving oil prices higher. A weakening dollar. A government running an unsustainable deficit. A financial sector addicted to leverage and exotic instruments. Now I want you to look at today. The Dow was up dramatically in the years before our current economic stress. Trade tensions have returned, and they are actually worse. The Federal Reserve is stuck between a weakening labor market and elevated inflation. Oil prices have been rising sharply because of geopolitical conflict. The dollar is under pressure. The U.S. national debt has crossed $36 trillion, and the financial sector is loaded with instruments that nobody fully understands. Listen, I am not predicting another Black Monday happens tomorrow. I am not in the business of making exact predictions like that. But what I am saying is that the pattern, the macro setup, the conditions that created 1987 are echoing loudly in today's data. Former Goldman Sachs co-chairman Robert Rubin recently said publicly that when he speaks to people in the markets, he says there is one date they should keep in mind. October 19, 1987. He said for years before that crash, conditions were considered highly excessive and nothing happened in the markets. People stopped listening. And then the Dow was down 22% in one day. If this trend continues, if the labor market keeps weakening, if oil prices keep rising because of geopolitical instability, if the Federal Reserve keeps getting squeezed between inflation and unemployment, if the junk bond equivalent of today, which is leveraged corporate debt and speculative technology valuations, starts to crack, we are going to be in trouble a year from now. It is as simple as that. We are being told by mainstream media and by politicians that we are in a period of economic strength, that the stock market reflects the health of the economy, and that the American consumer is resilient. But the data I have shown you today tells a different story. The data shows a labor market that posted a loss of 92,000 jobs in February, an unemployment rate that is trending in the wrong direction, oil prices that are accelerating higher, a Federal Reserve that is telling you it will wait and see, which is central bank language for we do not know what we are doing, and a macro environment that rhymes more closely with 1987 than any other moment in recent memory. They are living in ignorance, living in bliss, and I refuse to do that to you. So here's the takeaway from this entire video. In 1987, the investments that survived were not the exciting ones. They were not the junk bonds. They were not the IPOs. They were not the algorithms that were supposed to be genius. The investments that survived were the boring ones. Treasury bonds, which rallied when panic hit. Gold, which served as a store of value over the full year. And quality businesses with real earnings held with conviction through the chaos. The pattern has not changed. The fundamentals of crisis investing have not changed in 4 decades. What changes is the names and the technology and the specific instruments. But the underlying truth does not change. When fear takes over, capital flees to safety. And the people who had already positioned themselves in safety before the crash hit were the ones who came out the other side in a position of strength. The writing is on the wall. The data is right there for anyone who is willing to look at it honestly. And I am just one of the few people willing to show it to you. If you want daily updates on what is happening in the economy, the real numbers behind the headlines, and the analysis that the mainstream financial media will not give you, please subscribe to the channel. It costs you nothing, and it means everything to this channel. Thank you so much. Have a very nice day. Take care.